Welcome back to the Daily Hunt for Multibaggers, your go-to source for AI-generated market commentary and insights. It's Monday, October 20th, 2025, and we're looking at all the data that came in yesterday, Sunday, October 19th.
That's right. After a remarkably quiet Sunday with hardly any significant social media activity, the discussions have really picked up today. Our AI flagged a healthy number of posts across several familiar names like AMD, Nvidia, Amazon, and Tesla, plus a few emerging companies like CCCX and AGI.
And today, we've zeroed in on two of the most talked about stocks from our analysis, Tesla, TSLA, and Nvidia, NVDA. It's a really mixed bag of signals out there, Brooke, with some strong growth stories, but also some significant risk factors that our AI has highlighted. Well, Tesla, it's always a hot topic, isn't it? Our AI flagged it again today, and what's interesting, the stock's currently trading really close to its 52-week high. That's usually a sign of strong market confidence, indicating people are still bullish on the brand's long-term vision and continued innovation, despite recent headlines.
Even I hear you on the market confidence, but our KPI analysis tells a very different story here. The price to earnings ratio for TSL is exceptionally high at over 260. That kind of valuation is typically reserved for companies with explosive revenue growth. But here's the kicker. Our data shows negative revenue growth at negative 1.18. That's a huge red flag when investors are paying such a premium for growth that just isn't there right now. Plus, the company also carries a high debt to equity of 16.823.
Fair point, Brooke. Those numbers certainly do raise eyebrows. But what about the upcoming Q3 earnings? That's just 2 days away, on the 22nd. There's a lot of anticipation, and if they pull off a surprise, that negative sentiment could quickly turn around, couldn't it?
Anticipation, yes, but also uncertainty, as our AI's analysis notes. And when you factor in professional analysts like Barclays lifting its price target to $350 and Exane BNP Paribas initiating coverage with an underperform rating and a 307 price target, both significantly below the current 439 price, you really have to question the immediate upside, especially with those fundamentals. Our AI-generated insights lean towards a very cautious approach. This is consistent with our previous stay-away ratings, which have been quite consistent for TSL, dating back to September.
Yeah, it has been consistently stay away from our system for a while now. All right, given those points, it's hard to argue against caution here. For TSL, our market commentary suggests stay away. Okay, let's move to Nvidia, another tech giant that always sparks debate. Now, we had two different AI analyses on NVDA today, reflecting different social media discussions, and the insights are quite fascinating. Looking at the first set of data, some users are expressing real concern about a potential AI bubble. They're questioning if the rapid increase in AI spending is even sustainable, worried about high valuations.
Exactly, Ethan. Our AI flagged a bearish sentiment there, with users directly questioning if companies can continue this level of spending without impacting shareholder returns or if the ROI will ever materialize. And the KPIs from that specific analysis back up the concern. A PE over 52 and a price to book over 44 are extremely high. That suggests a lot of future growth is already baked in, making it quite vulnerable if AI spending slows down. The high beta also means it could experience larger drops during a market correction, just as some users predicted.
But wait, then we looked at a different set of discussions, and while the user sentiment there was neutral, the company's performance metrics were absolutely stellar. We're talking about a phenomenal revenue growth of 55.6% and an incredible net profit margin of over 52%. These are the kind of numbers that strongly justify a premium for a growth stock, signaling robust demand for their products. Analysts are still reiterating buy ratings, and Jensen Huang's announcements continue to show strong competitive positioning for NVIDIA.
Those numbers are impressive, Ethan. No denying the strength in their core business. But the PE of 52, while potentially justifiable by that growth, still represents a very high expectation. The high debt-to-equity ratio also warrants a closer look, you know? So, on one hand, you have explosive growth and exceptional profitability. On the other, you have community concerned about the sustainability of the underlying AI market demand and a valuation that leaves little room for error. Our AI's previous ratings for NVDA have swung between buy and stay away and cautious buy over the last month, showing this exact push-pull of conflicting signals.
You're right, Brooke. It's a real tug of war here. The fundamentals are strong, but the market's expectations are equally immense. Considering both the compelling growth story and the valid concerns about valuation and market sustainability, I think for NVDA, our speculative analysis suggests cautious buy. Investigate as buy. None. Investigate as cautious buy. NVIDIA Corporation, NVDA. Investigate as speculative gamble. Tesla, TSLA. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making any investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. That's all the time we have for today.
Thanks for joining us on the Daily Hunt from Multibaggers. We'll be back tomorrow with more AI-generated insights.